Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 63 on May 25th, 2019. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Carrizo Oil and Gas, Bausch Health Companies, and American Airlines. And we discuss three new trades on Sprint, Snap Inc., and National Oilwell Varco. Now, it's always great to hear from listeners, so if you have any questions about the trades presented here or even about your own positions, feel free to email me. You can also just email me and say hello. I do answer my own email. You can reach me at eric@theweeklyoption.com. That's ERIC@theweeklyoption.com, or simply send a message through the contact form on our website. Now, I've also created a short video series to teach you all the basics of option trading that you'll really need to be able to understand in order to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or watch the videos on YouTube. You can find them on the YouTube channel for the Weekly Option. Now, this was an interesting week. It's sort of an interesting period, if you will, in the U.S. equity markets. We've had volatility during the week, but once again, the markets finished with very little week-over-week change from a percentage change basis. The Dow moved less than 1%, and the S&P 500 moved 1% or a little bit more this week. Now, the Dow Jones Industrial Average fell 178 points, ending the week at 25,585 points. The S&P 500 index closed at 2,826 points, 33 points lower than it finished last week. So even though this period is not moving too much, definitely be ready. I'm sure we have some big moves. When you have periods of lower volatility week over week like this, typically no period stays forever. Seasons change. So when this period of low volatility changes, be ready for some opportunity. Now, the topic of the week is the difference in risk between selling a call and selling a put. So which trade has more risk to it, selling a call option or selling a put? And when I say selling them, I mean a naked, unhedged option. So is selling a call option more risky, or is selling a put option? Well, just to start this discussion, let's consider one thing. Stock, in theory, can go up to infinity. There's no limit, no upward limit on how high a stock price can go. Now, stock doesn't trade for negative, right? We never get paid to receive shares of stock, in theory. When you're looking at the stock market itself, a stock cannot be priced below zero. So that means that selling a call option is significantly more risky than selling a put. Showing this topic sort of came to mind earlier in the week when I was showing a friend of mine a trade strategy that leaves you with one extra naked put. Now, we were talking about margins required, and I sort of explained the difference in margin requirement is a function of the difference in risk. So when you sell a naked put option, your brokerage account will require you to have the capital to buy the stock. So let's say that we're using an option that has a strike price of $25. You'll need to have at least $2,500 in your account per put option that you sell that's unhedged or unspread off. So that's because when the prices fall below that strike, because you're short a put option, you actually will simply have to turn around and buy the stock. So they want to make sure that you actually can afford to buy that stock. Now, when you typically have to have a large account to sell naked call options, and that's because there's no upward limit on how high a stock price can rise. So it requires a larger account for you to be able to buy the shares, or to sell the shares actually, if that strike price ends up being crossed and someone exercises the short call position that you have. So how can you limit the risk, right? If you end up in a trade that leaves you with an extra naked option, how can you limit the risk? Well, one of the ways that I like is to simply create a spread by buying a further out of the money option. That will create either a call or a put credit spread. And we talk about credit spreads on the show each week. It's a spread that you sold. Typically, you're going to receive money for selling it, and that's because you're selling the option that is closer to the money. So by selling a further out of the money, by buying a further out of the money option, you actually not only you cut off the risk, right? It changes your upside potential, but you also limit the amount of risk and exposure that you have. So it's super important to understand risk. If you're going to trade options, you must learn and understand what happens with each individual option when you buy or sell it. If you understand what happens to the individual options, then it'll make it easier to understand what happens with spread options, what happens with any other complicated, book of options. It's just important that you understand risk. And so I created a course, the Option Studio. And so the topic of the week each week is sponsored by theoptionstudio.com. If you want to learn to trade options successfully and you want to learn to understand risk, visit the website for theoptionstudio.com and watch the video that's there. You can watch that video. It'll tell you a little bit more about option trading and about the course. And if you like it, jump in, because I'm accepting students at this point. It'd be great to have you. Now, let's dive into the trades for this past week. We're going to start off with the covered call. We looked at Carrizo Oil and Gas, symbol CRZO, Charles Richard Zebra Oscar. The stock at the time was trading for $12.92. We looked at buying stock and selling that June 13 call, collecting 85 cents. We were ultimately hoping for a 7.2% return over 5 weeks. Well, the market had a little something different in mind for us. Carrizo Oil, the stock fell $2.07 per share, ending the week at $10.85. The call option which we sold can be bought back for 15 cents, which will lock in a 70 cents profit on the option. Still, at this point, we've lost a total of $1.37 on this trade. Now, whenever I experience a loss on a covered call, my next action is to roll the strike lower. We do that by buying back the option that we sold last week and then selling the option that is at the money. So in this case, the at the money option is the June 11 call. We can sell it for 60 cents, and if stock prices finish above $11 per share at June expiration, our total loss would be a total of 62 cents per share. You could also add other trade strategies to this to help limit losses, like selling a higher strike call spread. You could also buy a put spread or buy just a single individual put against this position as a hedge. When you do something like that, when you're long stock, short an option, and then you turn around and buy that put, what you're ultimately doing is using that put price as downside protection or as insurance. So it all depends. This is yet another reason. This is the perfect example why I'm really cautious on actually executing covered calls. It's because we only had 85 cents of protection with our stock. That stock price can still go down lower than your call option, lower than the amount of money that you receive for that call option. So the stock actually creates the risk in this trade, and that's why the next two trades don't have any stock involved at all. So let's get into the next one. We had a credit spread on Bausch Health Companies, symbol BHC, Bob Henry Charles. Stock at the time was $25.06. We looked at selling the June 25-24 put spread at 34 cents, which leaves us with a maximum possible loss of 66 cents per option. Now, Bausch Health stock fell $1.54 this week, closing at $23.52 on Friday. That means that the put spread we sold is now in the money. That's not a good thing. You can buy back the spread. You can buy the spread in for 75 cents, and that would actually lock in a loss of 41 cents. Now, remember, this spread will expire worth $1 if the stock price stays where it is or stays under $24 per share. So I would definitely buy in the spread just to cut off that risk. Now, the stock chart appears to be in a sideways channel with the range between $22.50 and $27 per share. And even more importantly, each of those inner trends, the up and the down, seem to be roughly 3 weeks long. So I always look at not only the range, but the amount of time that it seems to be staying in each specific direction. So if that holds, this stock will see another week of lower moves before heading higher. So you could actually sell a call and a put spread closer to the outer price ranges, which makes it an iron condor. And you would expect the next price trend to last a little bit further out than the June expiration. So I would consider selling the June 22.5, 21.5 put spread for 19 cents and selling the June 25-26 call spread at 14 cents. That brings in a total of 33 cents to help offset the 41-cent loss you have from closing the original trade. Now, June expiration is 4 weeks away, and while these spreads individually are selling for less than what I typically want to collect in selling a spread, their combined value keeps me in the range. So I'm expecting stock to finish in the middle of the range, which would allow both of these trades to expire worthless. And even if it doesn't, only one of them can finish in the money. So once again, our risk is limited. Now, our final trade from last week was on American Airlines. It was a debit spread on symbol AAL, Apple, Larry. At the time, the stock was trading for $31.72, and we bought a June 33-32 put spread, paying 63 cents, and that leaves us with a maximum possible gain of 37 cents, or a 58%, roughly 59% return in 5 weeks. Well, American Airlines stock fell $2.55 per share, closing at $29.17. The in-the-money put spread we bought is now even more in the money. So that's great. I get at least one nice win for the week. With prices here, we expect to earn 37 cents or that, roughly 59% return in 4 weeks. You could exit the spread early right now as well and lock in 17 cents. So that might not sound like much, but consider that you only invested 63 cents. So 17 cents on an investment of 63 cents is a 27% return on your money in 1 week. And remember, we also want stock to stay below $32 per share. So you could stay in this trade and simply keep an eye on stock in order to protect your profits over the next few weeks. This trade is performing as expected. It's the only winner from last week. I needed at least one, because I hate when I lose on all three, which happens. I don't walk on water, but I do at least show you how to minimize risk, minimize loss, and hopefully put you back in a situation where you can make some money. So if you have any questions on any of the adjustments I made on these trades, definitely email me. And otherwise, we're going to move forward. So we are 4 weeks away from June expiration, and the market in the U.S. will be closed on this upcoming Monday in observance of Memorial Day. So if you are a military veteran, thank you for your service. And if you know a veteran or any current military members, give them a hug and thank them for their service as well. So all of these trades that I'm about to present, really you'd have to look to execute them on Tuesday. And given that there's a time value element to options, the prices will likely be much lower or a little bit lower on Tuesday. So definitely, be aware of that and look at pricing again before you decide to dive in. So we'll start off with the covered call, just like we do on every show. We're looking at Sprint, the telecom company, symbol S as in Sam. It finished the week at $7.16. And we're looking at buying that stock and selling the June 7.5 call at 35 cents. If stock is higher than 7.5 at the end of June expiration, we're looking at a 9.64% return. You enter this trade by buying stock for $7.16 and then selling the June 7.5 call at 35 cents. This trade makes the most money if stock prices finish above $7.50 per share at expiration. Now let's get into the credit spread. We're looking at Snap Inc., symbol SNAP, Sam, Nancy, Apple, Paul. The stock ended the week at $11.56, and I'm looking at selling the June 1150 11 put spread, collecting 18 cents. And that leaves us with a maximum possible loss of 32 cents. This is the company, this is Snapchat. This is the company that owns the product Snapchat. And they actually had some interesting news come out this week. First off, there's a question of employees mishandling privacy data, user information. So that's actually a negative. But the reason why the market seems to be going higher and staying strong on this is that they signed a deal with a music company, and they'll be able to add or at least pair their service with music going forward. And I think investors and analysts are expecting that to push the stock quite a bit higher. Now, you enter this trade by selling the June 1150 put at 57 cents and concurrently buying the June 11 put at 39 or 439 cents. This is a credit spread because we are selling the spread. And this trade makes the most money if stock prices finish above $11.50 per share. Then our final trade on the week is a debit spread on National Oilwell Varco, symbol NOV, Nancy Oscar Victor. Stock ended the week trading for $22.39. And I'm looking at buying that June 22 half put spread at for 31 cents. That creates a maximum gain of 19 cents if the spread stays on the money, or roughly 61% return over 4 weeks. Now, you enter this trade by buying the June 23 put for $1.31 and then selling concurrently the June 22 half put at $1. This is a debit spread because we are buying the spread. And this trade makes the most money if stock prices stay below $22.50 per share at expiration, at June expiration. So that's it. I hope you guys, if you're here in the U.S., I hope you're having a fantastic long weekend. We tend to look at Memorial Day as the beginning of summer, and summer is absolutely my favorite season. Even though I do love to ski, there's nothing like hanging out on a beach or inviting friends over for a little pool party. That is it for this week. Have a wonderful Memorial Day, and come Tuesday, happy trading. So long.
Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.